Hi, welcome to week 10. It is the week where we'll take a look at what we have done. Not too much detail actually, but focusing on what happened over the last 9 weeks on the main issues really, not on detail. So that's what's the plan for this week. But I wanted to say that it's been unbelievable how quickly this time has passed, and I hope you feel the same way. The program has gone week by week, just as it would in a classroom, and I hope you enjoyed that and had time to do all the assessments, assignments, basically to keep up. And today what I'm going to do is I'm going to have a relatively shorter video because we'll hit on the main elements and wrap up with some advice and so on regarding things that you may want to look into further. So let's talk about what this course has been all about. And by now you must be kind of sick and tired of this quote-unquote balance sheet. I like to call it a snapshot. So if we focus on that for a second, what it allows us to do is create a context of what we are talking about. The nice thing about finance is it's always in a context. Even if you think about it theoretically or conceptually or in a textbook manner, the beauty of it is you have your own context in mind. So if you stare at this, there are real assets that you possess or plan to possess. And on the liability side is how do you finance these? The good news is that we have learned a bunch of principles which apply to both sides. In other words, what I mean is whether you're evaluating real assets, which has been the focus of this class, or you're evaluating financial assets, here in this case we call them liabilities, because an asset financial for one is a liability for another, the principles we have learned are identical. And in fact, I would say the following, that in the beginning of today's review, I will focus largely on what we have done in the last few weeks, but then go back and see how actually that's not been our focus throughout. The focus has been on both sides of the balance sheet, but in creating value, we want to focus on the real asset side. So why is this graph or this picture good? Because it reminds us of many things. So the first thing it reminds us is that when value is created on the real asset side, you can think of it in two terms, and we'll do this again, cash flows and the return on asset. And I would like you to think of this always before you start thinking about how people raise money to do what they want to. And when you're focusing on this, you realize that RA comes with some risk. So never think of a return in isolation. Always think of return and risk in pairs. And we spent a lot of time understanding what risk was all about, because without that you cannot figure out what the return should be. If you look at this graph, I haven't even touched the right-hand side. And I have prevented myself from going there very often. And the reason is that I want you to understand how value is created and where it's created. And then, if you want to think about equity and debt, think about the division of RA and beta A. So the first thing that you have to recognize is that return on assets and risk of assets is the primary determinant of value. And then when you finance it in different ways, you kind of divide up the risk and return. So the risk and return is kind of given once you've chosen what to do. So for example, if you've chosen to be orange, you would have risk-return profile of Apple. If you've chosen to be similar to GE, which is a tough thing to do, your risk-return profile will be similar to GE. But the financing piece will just be how you divide up the return that you gain in each particular industry. So for example, if you're focusing on orange, you'll get a certain return on assets. And then if you have no debt at all, you'll have return on equity and return on debt. If you have no debt at all the return will pass along to the equity holders. On the other hand, if you have debt will get the return first, and then return on equity will be, or cash flows to equity will be given. This is a very important point, that at the end of the day, there has to be some sort of friction to break this natural phenomena, which is create value by good ideas, assets, projects, and then you divide them up. So the determinant of value creation is RA, not RE and RD. It turns out that RA is not observable, so we have a lot of focus, even in this class, on figuring out RE and RD. So I wanted to show you this picture right up front today so that you remember this simple idea, that unless you've figured out what the value of your real assets are, there's no point thinking about what the return on equity or return on debt is. However, in the real world, if you're starting a new project, you'll go look at a comparable to figure out what your return on assets are. You may almost surely have to go through an analysis of RE and RD, because the addition of the two will lead to RA. What I didn't spend a lot of time on was taxes. And turns out in the real world, taxes favor at the corporate level debt and not equity. So you'll see in the weighted average cost of capital formula, RD being lower after tax. And we did that last time. In this class, I'm not focused on things like taxes and all. You can learn that stuff on your own. However, having said that, as you'll see later on, I will encourage you to do classes which take into account details of taxes and how do you do valuation and so on. But if I did that before I did the fundamentals, it would be putting the cart before the horse, because taxes and differential treatment of debt and equity is a man-made phenomena, whereas what I'm showing you right now throughout this class, except towards the end, is human intervention, right? Is right at the end I showed you what humans can do to mess up what the natural phenomena is right in front of you. But that is, value creation happens on the asset side and you divide it up between equity and debt. One path-breaking result of that was that how you finance in that world is not relevant to the value. And that's pretty much what I wanted to say regarding this. What I'm going to do is I'm going to keep going, and I would encourage you to stay with me before we take a break, because the next few points I want to make is within the context of this balance sheet. So let me just continue and emphasize value creation happens when the NPV is positive. Now, NPV itself has some shortcomings, and again, I'll visit that later. But if you stare at this equation, which should be part of your system by now, you see that there are only two things to worry about. Difficult to figure out because they are for the future, and the two things are cash flows and discount rates. So the other thing I wanted to emphasize again, and this is something I said last time, but you know, saying it and doing it are two different things. So I want you to recognize that if suppose you made the investment 3 years ago and started the company 3 years ago, and today I ask you, what is the value of the firm or value of the entity you're evaluating? Remember, simple. Look forward and figure out the present value of the cash flows. So the minus I naught, if it's happened in the past, is irrelevant. It's sunk cost. So you look forward and always value the future cash flows. And today, the value of all future cash flows has to be the value of your project. So throughout this course, what we did is we took these two basic ingredients, cash flows and discount rate, and we tried to see how to estimate both. We spent some time on cash flows, but here I'm not going to go into the detail. What I'm going to emphasize again is who do the cash flows belong to? And when I say belong to, obviously I don't mean you possess them, is what do cash flows signify? They signify the name. It's like your name. It's the name of the project. So as soon as you say project, you should be able to estimate what the cash flows are. And the projects could be anything, right? I'll mention that in a second again. The second piece was the cost of capital. As I said, this cost of capital, whenever you think about it, it's good to think about return on asset. And then if there is a tax issue, you can think about an adjusted cost of capital. So cost of capital, which is RA, who does that belong to? And I think it's good to think of market right away. Why? Because you cannot know the cost of capital of your business unless you know a comparable. Because the idea of competition is you're creating value in relative terms. I'll hit all these major points in the next few slides in a second, but I wanted to just focus on these two elements. So what did we do? We spent some time on cash flows. I would say about 20% of the class hit on cash flows, estimation, talking about, and so on. Why not 50%? Because I think cash flows are relatively easy to think about. However, on the other hand, cost of capital is much more subtle to think about. So we spent a fair amount of time on risk, understanding risk, and the cost of capital, which is what we did in the last, say, 40% of the class. We also spent a little time on financing. And the reason we spent a little time on financing is because, I think you know it by now, the return on asset cannot be seen directly. And financing allows you to get to RA because equity is traded. And this again goes back to the fundamental assumption we have made, that if there are markets, you can observe equity trading. In fact, equity is such a complex instrument, yet it trades, which is fascinating. So the notion of financing in this class wasn't directly relevant. The notion of financing was relevant only because in the real world, the only way to get to the return on assets of a comparable, which becomes your cost of capital or discount rate, can be seen by evaluating equity and debt, both of which can be readily observable, especially relative to assets. I would encourage you to take a break now, and I'm going to come back and hit upon what I would call principles that underlie everything we have done. So the focus next time will be on hitting your head repeatedly with things that you should never forget. Okay? So see you in a little while. Let's take a short break.